All right. So last week we started with conceptual framework. So our target today is to finish it up. And when we started with conceptual framework, I told you that conceptual framework basically is the foundation of reporting. And one of the key uses of the conceptual framework is that it is used for developing new accounting standards. And from there, that was where we concluded that this conceptual framework is the foundation of reporting itself. Then we looked at some of the advantages of this conceptual framework. And some of the advantages that we looked at was that it makes development of accounting standard to be standardized and coherent. And also we said the development of accounting standard will not be subject to political interference and these other advantages also. We also looked at the disadvantages last week as well. Then we went on to the purpose of the conceptual framework. And in determining those purposes, we said we should identify the users, those that are direct beneficiary of this conceptual framework. Then if you identify those guys, then whatever they are using it for will represent the purpose of this conceptual framework. And the people we looked at was from the IASB, who use it to develop accounting standard. And also the IASB also use this conceptual framework in harmonizing international regulations or international accounting standard, which is one of the key objectives of the IASB. Then also there is the national standard setting bodies. It's also helped them also to develop their national standard. There's the preparers, which it helps in applying the IFRS, and it also helped them to develop consistent accounting policy. And we looked at some other people also last week. Then finally, we said that when there is a conflict between the requirement of a conceptual framework and the requirement of of the accounting standard, we said that of the accounting standard will override if there's a conflict between the two. So even though it's the conceptual framework that is used to develop accounting standard, but when there is a conflict between those two, is the specific requirement in the accounting standard that will override that of the conceptual framework. We mentioned that here also. Then when we're done with this part, we looked at some quizzes last week also. Then we went on to the content of the conceptual framework. We said that the conceptual framework we are looking at is the 2018 conceptual framework. And we said there are 8 chapters there. From the chapter 1, which talks about the objective of a general purpose financial report, to the chapter 8, which talks about the concept of capital and capital maintenance. So last week, we successfully finished chapter 1 and chapter 2. So today, we'll just look at the remaining, then we'll be able to, let's see if we can finish it, then let's see what we can go from there. In the chapter 1, that looks at the objective of a general purpose financial report, we mention what the objective of a financial report is first, which is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. We explained this objective. We broke it down. We explained what this financial information is. We said this financial information are just economic resources of the entity, claims against the entity, and changes in economic resources and claims. Then we went on to explaining these primary users. The fact that the conceptual framework is saying these are the people who provide information to the existing and potential investors, lenders, and other creditors. That shows that this set of people are the primary users of financial report. And also, we also look at these primary users, what are their information need? What do they need this financial information for. Of course, they want to use it to make decision, but the decision the investor is making will be quite different from the decision the lender would make and from what the other creditors would make. So we looked at all of that last week. Then we concluded that this financial information is prepared using accrual accounting. Then we went on to looking at some quizzes just to test that we have been following, after which we went on to chapter 2 of the conceptual framework. And this chapter 2 deals with the qualitative characteristics of a useful financial information. We said there are two qualitative characteristics. There is the fundamental characteristics and there is the enhancing characteristics. We said these fundamental characteristics are what makes the financial report useful or not useful. And the enhancing characteristics are what makes the financial report more useful or less useful. I would say the fundamental characteristics are majorly relevance and faithful representation. We explained them in detail, these two. And we said the enhancing characteristics are majorly comparability, verifiability, understandability, and timeliness, which we looked at in detail. So when we looked at all of these qualitative characteristics, then we went on to some quizzes. And after those quizzes, we ended the class last week. And I told you last week that this part might be theoretical, but it is extremely important for your exam because as you will find out when you're writing these diets, they ask almost every diet. So we are discussing a very important part of your syllabus, which is why it's coming first or the first of the 2 or 3 topics we are looking at. Okay, so today now, we are going to start with the chapter 3 of the conceptual framework. And the chapter 3 looks at the financial statement and the reporting entity. So first is this financial statement. This one majorly is talking about, one, the objective of a financial statement. And this is just a repetition of chapter 1 that is talking about that, which is to provide financial information about a reporting entity which is what they are just repeating here. So I won't go into so much of that again because it's just the same thing. But beyond that is the perspective. Chapter 3 also talks about the perspective of a financial statement, meaning how when we are preparing financial statement, we should prepare it with whom in mind. Okay, that's the perspective, and which is this part, perspective adopted in the financial statement. So when we are preparing financial statement, we are preparing it from the perspective of the reporting entity. Okay, so whom you are reporting is the reporting entity. Is the reporting entity you want to present financial information about. And you should not prepare the report from the perspective of the investors or any other party, because that might lead to misleading the users. Because we have found situation whereby, especially for listed companies, you will find out that analysts will have predicted certain numbers of profits for the company. So mostly when they are preparing their reports, their focus or their perspective is around that, which is wrong. The perspective of a financial report should be focused on the reporting entity. Report your own transaction. And that is what this perspective is talking about. And of course, going concern assumption, when you are reporting that reporting entity, when you are presenting information about the reporting entity, you must assume that they will continue to operate into the foreseeable future. Okay, so majorly this is what this financial statement part is talking about. It's talking about the objective and also the perspective of a financial statement and being concern assumption. So the perspective of whom the financial report is prepared is from the perspective of the reporting entity itself. Another thing is the reporting entity. So chapter 3 talks about the reporting entity. And this reporting entity, chapter 3 says that is an entity that is required or chooses to prepare financial statements. So meaning that a reporting entity might either be an entity that is required to. So these are mostly entities that are quoted or listed on an exchange, like the companies in the Nigerian Stock Exchange now. Those ones are required to. So it's a regulatory requirement that they have to present their reports to SEC. They are required to. And most companies that file returns with FIRS also, they are also required to prepare financial reports because they need to submit those reports to FIRS when they are doing their tax return. So required. However, there are some entities that just choose to, and this is especially sole proprietorship and partnership business. Those ones it's not really compulsory that they have to prepare a financial statement. They just choose to. They just want to know what their performance and what their position is. Okay. So a reporting entity, as far as chapter 3 is concerned, as far as this conceptual framework is concerned, is either an entity that is required to or that just choose to. Not only that, it can be a single entity or a portion of a single entity, or it can comprise more than one entity. So a reporting entity could either be a single entity. And when I say a single entity, I mean when we say companies like Unilever now, Unilever is a single entity, is a company. If I say a company like, let's say GT Bank on its own now, is a single entity. Our school, let's say Network now. Network is a single entity. That's a single entity. It's a reporting entity. A reporting entity can also be a portion of a single entity. When I say a portion of a single entity or a portion of an entity, we are talking about maybe a branch of an entity, or maybe a component of that entity generally. Okay, so basically a branch of that company. That can also be a reporting entity. When you get to higher level, you will see that there's a standard that deals with preparing report for a portion of an entity. That's IFRS 8 on operating segment. So we can prepare a report for just a portion of an entity because this conceptual framework sees that portion as a reporting entity on its own. Also, a reporting entity can also be more than one entity. And this will apply for companies that have subsidiaries. Okay, those ones will be required to prepare consolidated financial statements. It's also a reporting entity too, so it could be group of entity. Okay, now finally is that reporting entity doesn't necessarily have to be a legal entity. So when you're talking about an entity, don't see an entity as a company. An entity could be a sole proprietorship business. An entity could be a partnership business. So all forms of business constitute a reporting entity. Okay, so what we are learning now is we can prepare reports for whether an entity that is required to, or that chooses to, or that is a single entity, or that is a portion of a single entity, or there's a group of entity, and any form of business is seen as a reporting entity under the conceptual framework. Okay, so that is a reporting entity. Also, chapter 3 talks about reporting period. And when we say reporting period, this standard says that this is a specified period of time. Okay, so majorly reporting period, we are looking at the current period, maybe from January to December. Mostly is a period of 1 year, but reporting period goes beyond this specified period of time or just the current. When I say specified period of time, you're looking at this year, this current year. Okay, so it could be 12 months, it could be 15 months, depending on how long the entity has chooses to prepare its account for. However, reporting period also includes comparative, the periods that provide comparative information. Comparative information. So reporting period could be, when I say comparative information, I mean information of the previous period. So reporting period can also be the previous period. And also, under certain circumstances, forward-looking information. So in some instances, we will have to present information about the future. Okay, I think I gave you some examples under predictive value when I tell you how the information can make users make prediction, like providing information about discontinuing operations, providing information about non-current asset held for sale. But the focus here is that reporting period are majorly the current period and the previous period. That's seen as a reporting period in according to this conceptual framework. And finally, under this chapter 3 is consolidated and unconsolidated financial statement. The point here is this: when an entity prepares consolidated financial statement, that is an entity that has subsidiaries, this conceptual framework is saying that the consolidated financial statements are more likely to provide useful information to users than the unconsolidated. So you will learn very soon when you start doing group accounts under IFRS 10 that whenever a company has a subsidiary, it must prepare a consolidated financial report. And that's why the conceptual framework is saying that consolidated financial statements are more likely to provide useful information to users than an unconsolidated financial statement. Okay, so that is what chapter 3 of this conceptual framework is talking about. So far, ICANN has not really asked anything on this chapter 3, but they could ask. So just note majorly who may reporting entity. I'm really more concerned about this because don't see a reporting entity as a company. It could be any form of business. So a reporting entity is not necessarily a legal entity. And it could be a single, a portion, or a group of entity. And it could be an entity that just choose to prepare. So they could want to test your knowledge around this area. So please take note of it. And don't forget, consolidated financial statements are more likely to provide useful information than unconsolidated financial statements. Okay, so that's chapter 3 of the conceptual framework. Now, let's go to the chapter 4 of the conceptual framework that talks about the elements of financial statements. So there are 5 elements. We have assets, we have liabilities, we have equity, we have income, we have expenses. Okay. So the first thing here is they gave us the definition of these elements. Don't forget elements. They give us the definition. And for you guys, you have to know this definition. You have to know it by heart because they can ask you in the exam. Okay? And also, of course, understand it very well. So for assets, they define assets as a present economic resource controlled by the entity as a result of past events. They now went ahead. They said an economic resource is a right that has the potential to produce economic benefits. So look at it, a present economic resource. So when we talk about assets, firstly, we are talking about an economic resource. Before I even go deep into what economic resource is, you need to know that it must be present, meaning that you must have it. You must have acquired it. It must not be something you are planning to buy. No. You must have acquired, it must be on ground, right? So, but that thing you have acquired must be an economic resource. So, what is an economic resource? This conceptual framework says that an economic resource is a right that has the potential to produce economic benefits. What that means is that anything that makes money for you, that means is your own right. You're the one that has it. And it produces economic benefit for you. That thing is an economic resource. Anything, just think of anything that makes money, whether you can see it or you cannot see it, whether tangible or intangible, in as much as it can produce economic benefits, then there's high likelihood that you can put that in your books as an asset. There's high likelihood that it's an asset. So economic resource is when you have something that is making money for you, then that thing is an economic resource. However, before that economic resource can be recognized in your books as an asset, you must control it. That's why they said a present economic resource controlled by the entity. It must be controlled by you. And when we say control, it means that the economic benefit produced by these resources must flow directly to you. It must be flowing to you directly. If it is not flowing to you directly, then it is not, you don't have control. And control is the most important part of this definition. The benefit must flow to you. You must be the one that is collecting the benefit. You must not be sharing it with anybody. If you are sharing it with another person, that means the asset cannot be recognized solely in your books, but you have control if the benefit produced from this economic resource flows to you. And that makes this definition a present economic resource controlled by an entity as a result of past events. So this, as a result of past events, is just also saying that you must have acquired these assets. You must have acquired these assets, or there must have been a past transaction on these assets for it to be generating economic benefit. Okay, so that is the definition of an asset. So from this definition, we can think of a lot of assets. The popular one you would know are things like plant and machinery, land and building, furniture and fittings, and maybe accounting software and other intangible assets. But with this definition, just know that when an entity has something that is making money for it, and they are the only one that get benefit from that item is an asset. It is automatically an asset. And that is an asset. Now, the second one is a liability. Liability. The conceptual framework defined the liability as a present obligation of the entity to transfer economic resource as a result of past events. A present obligation to transfer economic resource as a result of past events. So the first thing here is that a liability is an obligation. Obligation. Before I go deep into what obligation is, it must be present. You must have originated this obligation. This obligation must be there. Not that you are planning to have an obligation. No, it must be there. So when we say an obligation, this conceptual framework, if you scroll down in my notes, you will see that he said an obligation is a duty or a responsibility an entity has to act in a certain manner. And this duty or responsibility, the entity has no practical ability to avoid it. So when you have to do something and you cannot avoid it, no matter what, you will definitely have to do that thing. Then you have an obligation. If it's something you can avoid and you say, no, I don't want to do it. Maybe you have to pay somebody and you can say, I'm not paying, and nothing will happen. Then that is not an obligation. And this obligation, this duty or responsibility usually entails that you would transfer economic resource. Okay, you transfer part of your economic resource. And obligation really, the primary one is what we call legal obligation. The one that if you don't do what you're supposed to do, they will sue you. Like a trade payable, for example. Now you purchase goods on credit from somebody, you now do not pay. They can come after you. The guy can sue you, get policemen, get a lawyer, stuff like that. Or you borrowed money from the bank and you are defaulting. Those ones are legal obligation because you have signed a contract that if you don't do it, you can do whatever. Those are legal obligation. But there are certain obligation that you didn't sign contract with anybody, but in a way, you have created a valid expectation in the mind of those people that you act in a certain manner. For example, an entity comes out in public on national TV, for example, now, and makes a public statement that they will give all youths in certain local government for 5,000. If you are the accountant of that company, immediately go and book a liability. Even though they didn't sign contracts with anybody, but they came out and make a public statement. There is what we call a constructive obligation because you have created a valid expectation in the mind of those people that you will give them 5,000. So there is an obligation already, and we will recognize the liability against the company. Because if the company does not do it, I mean, that is a reputational issue. That shows that this company is not a serious company and people might not want to even deal with them. So they won't fail. They cannot avoid it. Another one is, let's say in your company now, the MD just came up and say, hello guys, from today going forward, I want to be giving everybody lunch. He came out and said that. If you are the accountant, you have to start booking liability for that lunch because they have created a valid expectation in the mind of people. So those are constructive obligation. So, and that is what we mean by a liability. So a liability is a present obligation to transfer economic resource as a result of past events. That's a liability. Then the third one here is an equity. And from here, they said equity is the residual interest in the asset of an entity after deducting all its liabilities. So the first thing here is that equity must be residual interest in the assets. So when you say someone has an interest in something, in this case now in an asset, he has an interest in the asset. So mostly you'll be thinking of something like, okay, the benefit that is gotten from that asset is you also have a share in it. When you have an interest in it, meaning maybe mostly like an ownership interest. So whatever that is coming out from that asset, you also have an interest, meaning they will give you a portion of it. However, when you have an interest in an asset and your interest is residual, when we say residual, it means remaining or maybe remnant. Okay, which means that these returns or this benefit from these assets, when they are sharing it, they consider you last. You are the last person they will consider. Or even when the company liquidates and they are selling the asset and sharing the proceeds to those that have interest, and it is you they consider last, they know that your interest is what we call equity. It's an equity interest. And popularly, equity interests are majorly ordinary share capital and maybe reserves, right? So the ordinary share capital, according to Kama, they are the major risk taker in the business. They are the one that get paid dividend last. When the time we expose you to POL, you see that we'll pay all our expenses here. We'll pay interest to debt holders. We'll pay government their own tax. Is the retained profit after we have paid everything. Whatever profit is now remaining, that will now share to these ordinary shareholders. That means they are equity. That's what we mean by equity. residual interest in the asset after deducting all liabilities. All liabilities. So that's equity. Then the next one is income. So according to conceptual framework, it says that income is an increase in assets or decrease in liabilities that result in increase in equity other than those relating to contributions from holders of equity claims. So first is that when we say income, we're talking about increase in assets. So anytime your asset increases, that increase is an income. When your asset increases, that increase is an income. So this increase in asset now, it could be in two ways, okay? Is either you are talking about maybe enhancement of that asset. You produce something from that asset, right? So whatever it is, you can represent an income when you eventually sell it. Or it could be as a result of maybe the value of the assets went up, which we call revaluation gain or revaluation surplus. When you have a revaluation gain or revaluation surplus, it is also an increase in assets. But those kind of increase in assets, we call them unrealized. We are still going to talk more about them later. Unrealized asset, unrealized gains, or unrealized income. But the point still remains that it is still an income. Or if your liability should decrease by whatever means, you are owing somebody 15 naira before, then maybe the person says, okay, don't pay again. There's a decrease in your liability. When liability decreases, that is an income. And you see, this increase in asset and decrease in liability will always result in increase in equity. So see this increase in equity as an increase in your capital. Okay. But when we say increase in capital, two things can increase your capital. One is maybe there's an additional capital. You brought in more money or you made profits. Those can increase your capital. So which of those two are we referring to here? They went ahead and said that this increase in equity is other than those relating to contributions from holders of equity claim, meaning that this increase in equity is not additional capital, is not contributions from holders of equity claim. We are not talking about additional capital here. That is what these guys are saying. That means this increase in equity here is majorly profits. Majorly profit. So when we talk about income, increase in assets, decrease in liabilities, that results in increase in equity. And this increase in equity is other than those relating to contributions from holders of equity claims. Then finally is expenses. So when we say expense, it's just the reverse of income. So expense, when your asset decreases, that will be an expense. Or when your liability increases, that will be an expense. And this will result in a decrease in equity. And when we say decrease in equity, two things can decrease in your equity. One is if you are paying dividend, it decreases your equity because you are paying dividend from reserves. Then two is when you're making losses. Losses decreases your equity. So which one are they talking about here? It says other than those relating to distributions to holders of equity claim. Other than those relating to distributions to holders of equity claim. So saying that this decrease in equity is not dividend. Other than those relating to distributions to holders of equity claim is dividend. So this decrease in equity is not dividend. So that means this decrease in equity here is losses. So dividend is not an expense. Dividend is a share of profit. You will see when we get to statement of changes in equity, which is our next topic under IS1. So this expense here is loss. Loss is expense. Dividend is not an expense. The same thing here. Increase in equity. they said it's not additional capital, it's not contributions from holders of equity claim. Additional capital is not an income, is equity, is additional equity, is not an income. The same way dividend from your profit is not an expense, it's an appropriation of profit. Okay, so everything, the reality is this, everything we will be talking about in financial reporting is around these 5 elements. So your good understanding of these 5 elements will help you in our studies throughout the, I think we have like 14 weeks to go now for our lectures. It will help you all through your studies in financial reporting. Okay, see, all of those explanations I've been making, I've actually taken time to explain everything in your notes. For those of you that have read your notes, you will have seen it there. If you have not read it, please be reading it. Okay, so in line with our practice, let's look at these quizzes together. Let's look at these quizzes together. So now it's time for you to participate. So the first one says that in accordance with the IASB, the conceptual framework for financial reporting, what is the definition of income? So I don't have to read it out. Just quickly read it and tell me what the answer is. You don't have to talk if you don't want to talk. You can just type the answer on the chat box. I would see it and know which one you're picking. So what's the answer? Okay, Abiodun said C. Okay, that's correct. So let's go to this. Let's go to the next one. The next one says that when a PLC purchased a patent for 20,000, the patent gives the company sole use of a particular manufacturing process, which will save 3,000 a year for the next 5 years. What element of financial statement is the patent? What's the answer here? What's the answer here? Abiodun said D. Let's look at it. So Rena PLC has purchased a patent for 20,000. The patent gives the company sole use of a particular manufacturing process, which saves 3,000 for the next 5 years. What element of financial statement is it? So is it an asset? Okay, so when we say an asset, we are talking about a present economic resource controlled by the entity as a result of past events. So anything that generates money for you and the benefit comes to you. So this looks as like an asset because you bought something and you have the sole use, so you have control, and it will save you 3,000. So that means it's generating benefit from you in form of savings. It's not a liability. Liability, you have an obligation to transfer. It's not an income. It's not an increase in asset decrease. It's not an income. It's not equity, and it's not an expense. It's not an expense. Expense is a decrease in asset and an increase in liability. So it is not an expense, it is an asset because it's making economic benefit for you in form of this savings of 3,000. Okay, good attempt anyways. So the third one said that Ade Limited paid Wuse Baba 10,000 to set up a car repair shop on condition that priority treatment is given to cars from Ade. What element of arrangement in this 10,000? Okay, this kind of this not funny, but you have to be very careful here because this guy, he gave Wese Baba, Ade gave him 10,000 like a gift. I don't know. Shall give him 10,000. I'll go and use this 10,000 to set up a car repair shop. And the only condition he attached is that whenever my car come, please give it a priority treatment. Maybe he doesn't want to wait. Anytime his car come to that shop, they should just immediately attend to him. And he didn't even say he's not going to pay. They should give him priority treatment when his car come there. So you're now asking that the 10,000 paid by a day or the 10,000 a day gave to Wese Baba, would that be an asset, liability, income, equity, or expense? What would that be? What should it be? It looks like an asset because looking at it, it looks as if he would get benefits. But the fact is, for something to be an asset, control is very important. When you say an asset, you have control. You have control over that thing. Okay? That if the car repair shop now, the money they are making from it is coming to Ade, then you can see, okay, the 10,000 is an asset. He has invested in an asset. But in this case, he just say they should give him priority treatment. I mean, that cannot be flow of economic benefit. Flow of economic benefit is either you are making money or you are making savings. Okay, so it is not an asset and it's not a liability because it doesn't have any obligation. So liability is out of it. And it is not an income because when we say income, we are talking about maybe you have made money. The money you have actually made from your assets. There's an increase in assets. There's a decrease in liability, right? You're supposed to, they saved you money, decrease in liability. That's an income. That's what we call income. Money you have actually made. And when we say equity, equity is a residual interest in the assets, meaning you have an ownership interest in something. So if Adibaba has said that, okay, Ade Limited, if he has said that I'm giving you this 10,000, and this 10,000, it means that I will be a partner in this company. I'll be a partner in this company. Then we'll be talking about equity. Now, however, is it an expense? One is that this guy has parted away with money, so there's a decrease in his assets. I mean, that alone shows that it is an expense. So he had just incurred an expense because to us, he just gave the guy money that I'm just helping you. So it's just like a company giving donation to somebody. That's how it looks like. Okay, that's an expense. I'm just giving you. He just gave Adibaba. So that's that. So the final question for today, before we go to another on this part of our work today, is he said that a truthful limited provides a warranty with every car sold. What element of financial is meant in this warranty? Is it an asset? Is it a liability? Is it an income? Is it an equity? Is it a liability? Truthful Limited provides a warranty. So what would this be? Anybody? Okay, Shoyinka said expense. Okay, warranty. Okay, let's look at it. When we say warranty, what warranty means is that if there is, I'm selling this car to you, but if there is a damage, like a technical damage, you can return it. I will repair it for you for free. I would repair it for you for free. Just like you bought something from a supermarket, and supermarket says that there is a 1 year warranty. So if anything should happen to it, in as much as you are not the one that intentionally damaged it, if anything happens to it, bring it back, we'll replace it. So if companies gives that kind of warranty, one, that's not an asset because it's not like they are making money. Two, liability. When we say liability, we are talking about a present obligation. Yeah, so Muibat Abdurrahim, you're correct. It's actually a liability because when you have provided a warranty, meaning you have a duty to act in a certain manner and you have no practical ability to avoid it. The only way you can avoid it is if the car does not, if those guys don't bring it back. If they don't bring it back. But even at that, accountants were always prudent. You know, you don't want to overstate your assets. You don't want to understate your liability. So anytime we give warranty, we always make a provision that in case they return it. So there is a liability already. Since you have told them that they can return it in case of any default, that's warranty. It's not an income, it's not equity, it's not an expense. It's not expense here because expense is a decrease in assets. It's not like you are spending money right now. No, we have only given a promise to some people that you act in a certain manner. So that is a typical liability. Okay, some of you participated, some of you did not participate. I would advise you to always participate. Whether your answer is correct or wrong, we don't care. We are learning. Okay, now let's go to chapter 5 of this conceptual framework. This chapter 5, this chapter 4, they have asked it severally. Chapter 5 too, they have asked it, and they could ask it again. And what is chapter 5 talking about? Chapter 5 is talking about recognition and derecognition. Recognition and derecognition. And when we say recognition, recognition is just the fancy word for recording. Recording. So we don't say recording, we rather would say recognition. And it's just the process of including elements, all those elements we just discussed in the financial statements, whether financial performance statement or financial position statement. So when the process of putting it in your books, in those statements, those elements in your books, that is what we refer to as recognition. So before you recognize an item in your book, there are certain recognition criteria that must be met. So it said that an asset or liability should be recognized if it will both be relevant and provide users of financial with faithful representation of the transaction. So there are two recognition criteria from what I just read here. And one is relevance. One is relevance. And two is faithful representation. So they have asked it before that according to the conceptual framework, what is the recognition criteria for asset and liability or for element of financial statement? One, relevance, and two is faithful representation. Now, have you heard of relevance and faithful representation before? And under what did you discuss it? Hmm? You don't have to talk, you can just type it. Where did we discuss relevance and faithful representation? Where did we discuss relevance and faithful representation in this class? If you have not discussed it before, just say we have not discussed it before. I just want to be okay. Abiodun said chapter 2. Yeah, it was in chapter 2. And that was the fundamental characteristics. There are two fundamental characteristics, relevance and faithful representation. Okay, good. Good one, Abiodun. So what this chapter 5 is saying now is this. The recognition criteria now, based on 2018 conceptual framework, is just those two fundamental characteristics, relevance and faithful representation. And that is it. And that's the recognition criteria. And another thing is this. When we are talking about recognition criteria, the conceptual framework only talked about assets and liabilities. It ignored, because there are 5 elements now. There's asset, there's liability, there is income, there is expense, there is equity. Why didn't you refer to that when you only refer to asset and liability? The reason is this. You see, income, for example, now, income is generated from assets and even liability, majorly asset though. So income is an increase in assets, decrease in liability. So as soon as you have assets, automatically it is the asset that generates income. Also, when we talk about expense, expense is a decrease in asset, increase in liability. So is these two that also create your expense. Also is your equity. Equity majorly is just your asset minus your liability. So as soon as you recognize asset and liability, automatically it leads to creation of income, expense, and equity. And that is why they have mentioned or referred to just asset and liability here. Okay, and that's recognition. The next one is derecognition, which is the opposite of recognition. So derecognition is removal, okay? Removal of those elements from your report. When you include it, when you recognize it, at some point you might have to derecognize it. And you derecognize assets or liabilities. One, you derecognize an asset when you lose control of that asset. Remember, I told you when we're defining assets, we said control is the major thing there. If you don't have control of those economic resources, you cannot recognize it as your asset. So as soon as you lose that control, you have to derecognize it. You have to remove that asset from your books. Or you can recognize a liability when you have settled your obligation. That is, you no longer have an obligation. Remember, a liability is a present obligation. When there is no obligation again, derecognize it from your books. Okay, they can ask you this in your exam, please. Derecognition criteria. This part of your syllabus is so important that I cannot overemphasize it for you guys. So important. It's even much more important than some calculation I will start teaching you. And why am I saying this? Because you can easily pick points in the exam. They ask it often, and it's theory. As soon as you're able to answer it based on the notes I've given you and my explanation, you will get 10 marks, 7 marks. That's how they ask it in the exam. For example, now, Mr. Kazim has been teaching you income tax. It's not easy to pick 7 marks on a question of income tax. It's not easy. They say 7 marks and they now give you the question. Only very few students will be able to get almost 5/7 because a lot of steps and all of that. But this one, they can ask you recognition criteria. They can ask you to explain relevance, faithful representation, substance over form. Just know it. Then you would explain it to them and move on. Okay, so that is it for chapter 5 of the conceptual framework, talking about recognition and derecognition. Now, let's go to chapter 6 of the conceptual framework, which talks about measurement. Measurement. And what does measurement mean? It means that determining the monetary value of the items you have recognized. So you have recorded or recognized elements in your financial statements, then at how much? How much are you putting it in your books? That is measurement. So measurement is the monetary value of those items recognized. So what are the monetary value? Here, we call it measurement basis. So what are the measurement bases that we use in reporting? The most popular measurement basis, one is historical costs, and two is current value. There's historical costs and there's current value. The most popular out of the two is historical costs. That's the most popular, even though as they are updating accounting standards, they are moving towards current value. And why is that happening? Let's look at what historical cost is. Historical cost is that the price at which an asset was acquired or the amount at which you borrowed a liability. This value don't change. Historical costs do not change. It's just like that. So let's say this is 2024 now. If you bought an asset in, let's say, 2020, you bought it for 50,000. If you are using if your measurement basis is historical costs, you see in 2024, that asset, you are still going to be putting it in your books at 50,000 at the amount you bought it. So that's historical costs. It doesn't change. You just be carrying it at that amount you have bought it. Okay. And unfortunately, I would say unfortunately, because that's what we are still using today in reporting, though they are updating, they are trying to change it. And the reason why they are trying to change is that it will make our report irrelevant. Imagine how much they sell a Corolla in 2020 and look at how much they are selling it now. Look at Corolla is almost those ones that they use for Uber is well over or close to 4 million now, even some Nigerian used. And then you buy it from less than 2 million, then for less than 2 million. But if you are using historical costs, is the amount you bought it in that 2020 that you still be carrying it in your books. And you cannot use that one for decision. Nobody can use that one for decision. But that's historical cost basis. And that is the basis I will still teach you for most assets, for most PPE. They use historical costs. However, as time move on, they are moving towards current value. Current value. So for current value, that one, if you bought an asset, let's say in 2020 for, let's say 2 million, current value will be updating the value of the asset based on new information and changes in economic environment. So current value is usually updated. So that one will reflect what is happening now. Okay. So for current value, so measurement bases are two: historical cost, current value. Now, under current value, there are three current value that we use. One is fair value. One is fair value. We have value in use, and we have current cost. These are the three current value you can have. And when do you use any of these three? So when you want to sell an asset, then the current value you will use is fair value. Okay. So if you look at the definition here, is price that will be received to sell an asset. or pay to transfer a liability. Okay. In an orderly transaction between market participant and the measurement dates, right? For now, that definition might not really be so crucial to you right now, but you can see fair value as the market value of an asset or the amount at which you settle a liability. But when is it used? It is used when you want to sell the assets. Then you will recognize that asset as you update the value to its fair value. However, when you buy an asset and your intention is you want to use it for the foreseeable future, maybe for 10 years, then eventually sell it. You know that you're going to sell it eventually, but you are using it for a long time. Then the current value you should use is value in use. Value in use. So I won't really go into calculating value in use now because you would appreciate it better. You appreciate it better when we get to where we will actually use it. And the only place you will learn it is just IS 36 under impairment. When I'm teaching you impairment, that is when we are going to use this value in use. Okay, but what I need you to understand now is that we only use it to represent our current value if our intention is to continue to use these assets for a long time, then eventually sell it. However, if it is to replace the assets, okay, if what we want to do is that we want to replace this asset, we want to buy another asset, then the current value that is relevant in that case is going to be current cost. And current cost simply means replacement cost. It's just how much you want to replace these assets. You want to buy a new one. You want to replace an existing asset. So what's the value? So the popular one that we'll talk about, historical cost, this one is a given. And we'll talk a lot about fair value. We'll say a lot about fair value, and we'll say a lot, we will not say so much about value in use. So this fair value mostly is synonymous to market price, and sometimes maybe the revaluation value of that asset. You want to get the value today, probably you want to sell it, and you now need to revalue for whatever reason, or maybe you want to get the current cost, you want to replace it, then you want to know if you are going to replace this asset, what's the value today in the market. So we'll see a lot of those values. So most of the things I've been explaining, I've tried to detail it down here so that when you are revising, to be easy for you to look through them. Now let's look at these two questions here. Let's look at these two questions before I move to the next one. It says that in accordance with the IASB conceptual framework for reporting, which of the following is not a measurement basis of financial statements? A, we have current costs. B, we have present value. C, we have value in use. Then D, we have historical costs. So which of these four is not a measurement basis? Soyinka, Muyibat, Abiodun. What's your answer? Which of these is not a measurement basis? Okay, that's correct. Everyone got it right. Question 2. Which of the following criticism does not apply to historical cost financial statements during a period of rising prices? Which of the following does not apply to historical cost financial statements during a period of rising prices? Number one, they are difficult to verify because transactions could have happened many years ago. B, they contain mixed value. Some items are at current value and some are at out-of-date values. C, they understate asset and overstate profits. D, they overstate gearing in the statement of financial position. Which of the following criticism does not apply? Does not apply to historical costs during a period of rising prices. Let me allow you to try, and I will explain each of those options to you. Okay. Shrinka said D. D. Okay, we'll look at that. I want others to also participate before I do the correction. I want others to participate. Muibat said A. Okay, let's look at it. Which of the following does not apply to historical cost financial statements during a period of rising prices? Let's see which of them does not apply. One thing, before I even go to this option, one thing I know about is a historical costs when prices are rising is that its value does not change. Its value does not change. Okay, so because it's historical cost, it's the price at which we acquired it. So let's see. A, they are difficult to verify because transaction could have happened many years ago. No, this one does not apply. Because historical costs, why is it difficult to verify? There is nothing difficult in it to verify. You know how much you bought it. You collected receipt, you collected invoice, so you can easily verify it. So Muibat, you're correct. So they are difficult to verify. No, they are not difficult to verify you. Oh, this one, it says they are difficult to verify because transaction, no, this one does not apply because they are not difficult to verify. Yes, so they said which one does not apply? This one does not apply now. It's A, so Muibat, you're actually correct. They are not difficult to verify. So this one does not apply. So let's see why B is not the answer. They said they contain mixed value. Some items are current value and some are out of date values. Yes, that's correct. Historical costs depends on when you bought it. The one you bought many years ago is still going to be carried in your book at the price you bought it that many years ago. So their value are already out of date. But the one you bought this year, those ones are current value. So when you have PP or assets in your books as 10 million, it will contain a lot of assets. So depending on when you have bought it, they will just mix all the costs together and call it PP. So yes, it contains current value and out-of-date values, right? So B, yes, it's actually applied to historical costs when prices are rising. So this is not the answer because this actually apply. The next one, why this is not the answer, it says that they understate assets and overstate profits. Okay, so when prices are rising, so if you bought your asset like 2 years ago for 10,000 and prices are rising in the sense that today now the value of the asset is like 25,000. Historical costs will not change. It will just be there at that 10,000 you bought it. It's like you're understating your assets. So yes, this applies. They understate your assets. And when you understate your assets, so then it also can overstate your profit too, because it will look as if you are not making the it will suppress mostly your expenses, especially items like depreciation, because depreciation will be small. Okay, so it's in a way you are going to overstate your profits when you are using historical costs. You overstate your profit because you are not using prices today. You are using prices of long time ago. If you are using prices of today now, then probably you will have your expense would have gone up because because the prices of things have gone up, then your profits will be at normal level. But you are using old price. You overstate your profits. You just be presenting profit that you cannot share in today's world. Another one is they overstate your gearing. When we say gearing, we are talking about the level of debt that you are using to finance your assets. That you are using to finance your assets. So by the time you have understated your assets, because when you say gearing, you are looking at the proportion of debts that I've used to buy assets or that is present in your total capital structure, in your total capital base. Okay. By the time you have understated your assets, so it will look as if you are financing your assets with a lot of debt, because debts or borrowing, those ones will have been showed majorly maybe at the prices of today. So by the time your value of assets are understated, your gearing will be unnecessarily overstated. So yes, this one do apply. This one do applies. The only one that does not apply is saying it that it's difficult to verify. No, it's not difficult to verify. It's actually very easy to verify. Okay, so that's why Muibat is correct. So A is the answer. Okay, so let's go to chapter 7 of this conceptual framework. And the chapter 7 talks about presentation and disclosure. And so majorly what this is looking at is saying that, okay, all the elements that you have recognized and that you have measured in your books, then how do you present it? How do you present it and how do you disclose it? So majorly all of these items, we will have presented it in our books eventually. So it really looks at like four things. Number one is that it talks about the principles of presentation. So I will not really focus so much on that. But what I will focus on is it also talks about the statement of profit or loss. It talks about the other comprehensive income. And it also talks about recycling. Okay, those are the things this chapter is talking about. So the first one is talking about the principle of presentation. So that majorly first was talking about that when you are presenting this financial information, you must ensure that your assets and liabilities that are of similar nature, you must ensure that you can put those ones together. You don't have to separate those ones, but asset and liabilities that are distinct or that are not similar, then you can separate those ones. You can separate those ones. And it also talk about ensuring that you don't put details that are unnecessary in the financial statements. Make it as concise as possible. We also talk about ensuring that you avoid a standardized approach when you are preparing your reports. Make sure that you tailor your financial information to what is happening in your organization. So that is what majorly these principles of presentation is talking about. I don't see them asking you this because there are other places that actually talked about all of these things in more detail. And there are one or two controversy around these ones, like this standardized approach. The reality is that in the reporting world now, we use a standardized approach. Everybody has the same template. If you check the banking industry now, all of them, everybody calls revenue, right? Whereas you should have probably in those in consulting now, they should call it maybe fees or professional fees. That should be their own revenue. Everybody should tell that's what this guy wants, but it's not that readily available right now. Then beyond that is that when we want to present income and expenses, it says that we should present it in a statement of profit or loss. That statement of profit or loss is also called statement of financial performance. You don't have to call it statement of profit or loss. Even if you call it statement of financial performance, it's also allowed. Okay, but majorly the bone of contention here is that income and expenses, this is where you present it. Then majorly asset and liabilities, then we'll be looking at statement of financial position, but he didn't even mention that. Then he went straight on to something we call other comprehensive income. Other comprehensive income. So one thing that you need to know first is this. This other comprehensive income is an extension of a statement of profit or loss. And in this other comprehensive income, what goes there majorly are unrealized income. Unrealized income. When I say unrealized income, I mean income like revaluation surplus or revaluation gain. Majorly, that's what is relevant for us as of now, revaluation. So if you have a building whose value is 50 million, they now evaluate. A valuer came and evaluated, and he said that the value is 55 million. That excess in value is a gain, is an income, but is an unrealized income because they could come again another time and say that the value is now 45 million. So it's not a permanent income or income that you might say you want to distribute to your shareholders, or something you can come and say that we have made so much money. So which is why they separated the income that go to POL from the income that go to other comprehensive income. Here, the income that go there are unrealized. We didn't actually do anything to get it. It's just an economic advantage. It's just like this dollar thing in Nigeria. Now, if you had a lot of dollar in 2019, you'll have been a multimillionaire by now. If you have so much dollar, you'll be a multimillionaire in Naira because you'll have made so much gain. Because before they devalued the Naira in May last year, before they devalued it, May or June, it was selling for around in the black market, it was going for around 600 Naira or less. In the official, it was around 400 and something, just last year. Now, it is now over 1,000. It's now over 1,000. Yeah. So those kind of gains should. Okay. So that is the other comprehensive income. Don't forget, we are still going to come back at it as we move on, but what goes there are majorly unrealized income. Finally, when we say unrealized income, they can become realized. They can become realized, like this revaluation gain I've been paying attention to. This revaluation gain, it can become realized if you eventually sell the building. So the building is worth 50 in your books. You revalued it now. It went up to like 55. You now sold it, and you sold it for 55. That gain, it has become realized. It is now something you can tell shareholders that you want to. So when items you put in OCI that are unrealized, when they now become realized, the term to use is that you are going to recycle them. You recycle or you transfer them from OCI, from other comprehensive income. You are going to take them to your statement of profit or loss, or you take them directly to your retained earnings. So that means you are taking them away from being an unrealized income to being a realized income. And that is what recycling actually means in this sense. So you will learn as we move on that when we want to recycle revaluation surplus, we don't recycle evaluation surplus to P&L. IFC still says that you recycle it to retained earnings directly. You transfer it to your retained earnings directly. You don't take it to your P&L. Okay, and that is it about chapter 7 of the conceptual framework. Here talking about presentation and disclosure. So we talked about the principles of presentation. We talked about income and expenses being to statement of profit or loss. We talked about the unrealized income coming to OCI. And when they become realized, you recycle them back to either statement of profit or loss or retained earnings. In this class, or in your syllabus, the only item of OCI we're going to learn is just revaluation surplus. That is the only one. Okay, and evaluation surplus is usually recycled through retained earnings. Okay, so the chapter 8, which is the last chapter. So this talks about the concept of capital and capital maintenance. The concept of capital and capital maintenance. So the first thing here is this. There are two things here actually. One is concept of capital. Two is capital maintenance. So let me jump to the concept of capital that we have. Let me jump to that first. We have two concepts of capital in financial reporting according to this conceptual framework. One is the financial concept of capital, and two is the physical concept of capital. Fast forwarding knowledge, what we use today in reporting world, in fact, what we're going to teach you is the financial concept of capital. And this financial concept of capital, that one, it sees capital, because what we are talking about here is your capital, the money you use to start the business, capital or equity. So under financial concept of capital, this one sees capital as in terms of monetary value, in terms of your purchasing power or how much you have invested in the business. So generally, the way we calculate capital today is just our net assets. Asset minus liabilities gives you your capital. And that is the financial concept of capital. If you tell the examiner that the financial concept of capital is seeing capital as net assets, that is, asset minus liabilities, you will fly. It's going to fly. Okay, so financial concept of capital is just equity. It's just asset minus liability. That's the financial concept of capital. However, the physical concept of capital, this is also recognized, as you can see it here. But we don't, it's not used. It's not used, but they can use it if they want to, but nobody goes there. And you will see why very soon. And this concept of capital sees capital as productive capacity of an entity. So when I say productive capacity, what I'm talking about is the unit you can produce. So the physical concept of capital does not see capital in terms of monetary value, your money or your net asset. No, it's not concerned about the money. It's looking at how much can this money, what can it produce? How many units of what you are selling can this produce? That is the physical concept of capital. So this focuses on your productive capacity or your operational capability. That's the focus of physical concept of capital. But unfortunately, what we use is just the monetary value. Nobody uses this concept of capital, okay? Because it's quite complex to apply. To understand its application, this concept of capital, then we need to go to what we mean by capital maintenance. What I mean by capital maintenance? So when have you maintained your capital? Now, it depends on which concept of capital we are talking about. Are we talking about the financial concept, or are we talking about the physical concept? If we are talking about the financial concepts, in this financial concept, you have maintained your capital when you make profits. Even when you break even, you have maintained your capital. Because for financial concept of capital, all it looks at is that, okay, what was your capital at the beginning of this year? You will say 10,000. What is your capital now? You say maybe 15,000. You have maintained your capital. If your capital should increase, that increase is profits. You have maintained your capital. When your capital increases, and that's financial capital maintenance, it just looks at the increase in your monetary capital. But for the physical concept of capital, this one does not just look at increase in capital, but rather it looks at have you maintained the unit you can produce? Let's look at this for you to understand it better. Let's focus on these figures here. Let's focus on these figures here. Look at this. So these are the beginning. These are the end. So one, we have an inventory. This inventory is 100 items. 100 items. At the beginning, we could buy these 100 items for 500 naira at the beginning. That shows that we could buy each of them for 5 naira each. That's what it means. So we could buy 500 naira. But at the end, we can't buy for 500 naira again. If you are going to restock, we will need 600 naira. So that means the price has increased from 5 naira per unit to 6 naira per unit. That's this one, the opening and at the end. Then other net asset, then was 1,000, and this one, the value did not change. So that means our total assets, if you add 500 plus 1,000 is 15, 600 plus 1,000 at the end is 16. And your total asset must be equal to your capital. Must be equal to your capital. That's why we have 15 here and we have 16 here. For the financial concept of capital, guys, they will say they have maintained their own capital because at the beginning, their capital is 15, and at the end is 16. They will say that our capital has increased by 100. So they will see that 100 as profits and that they have maintained their capital. But the physical guys, the physical concept of a concept of capital guys, those ones will say, okay, wait, yes, at the beginning is 15, and with this 15, we were able to produce 100 units, right? Because out of this 15, 1,000 assets is 500 naira that we're using to buy what we can produce or what we are selling. We can do 100. At the end, they will look at it that, okay, 1,000 still assets, but if we're going to buy the same 100, we will need 600. The physical concept of capital, guys, will look at the only reason why this capital has increased. This increase is only sustaining us to be able to produce 100 units. While the financial concept of capital, guys, might have even distribute the 100 as dividend. They will have distributed it in a way that by the time they go to the market, they will not be able to restock because they will have taken off 100 naira from here, remaining 500, and the price has increased. But these guys will say, no, our productive capacity is still 100 because the price has increased to 600, which is why our capital has increased. So this guy will say that, yes, we have maintained our capital, but we have not really improved it. we have not really made any profits. These guys do not recognize profits in their books because they know that this additional 100 naira is just to sustain their ability to produce 100 units. And that's the core difference between the financial concept of capital guys and the physical concept of capital guys. So, in summary, even though what we use today, most of what we are going to learn, we are not going to be considering our productive capacity. Nobody considers that today. But it's very important in business world. But the financial concept of capital guy, if you're not careful, it can throw you into trouble that you just recognize profits without considering, can you still produce what you were producing at the beginning? Just like this one now. At the beginning, 100 units was costing 500. At the end, it's now costing 600. So if you go and rely on the fact that your capital has increased by 100 naira, you go and spend that 100 naira, you will not be able to. So that's why a lot of people run out of business, because they don't consider these intricacies. Now, for you to even further understand it, there was a past question. Or is it I can part? Yeah. Look at this question here. This question 4. It says that S Limited commenced business on 1st January with a single item of inventory which costs 10,000 naira. And I said during the year, it sold the item for 14,000 cash. Then I said during the year, general inflation was 5%, but inflation specific to the item was 10%. Required. Calculate profits in each of the capital maintenance concepts. This is a very good question. There is a past question that I've asked it before. So there are 2 capital maintenance concepts. There's the financial capital maintenance, and there is the physical. For the financial, do you know what that one would do? Let me even try and give you a trial. Let me give you a trial. For the financial, how much profit do you think those ones will recognize in their books? You can just type it as a chart. How much do you think those ones will recognize in their books as profit for the financial? You can try. I'll give you few seconds to try. If nobody tries, then I'll just explain it. How much will those guys recognize as profit for the financial guys? Those ones will recognize 4,000 as profit. The sales, they will recognize sales 14,000 and costs, which is 10,000, and that's it. They will recognize gross profit of 4,000. But for the physical, those ones, they look at the productive capacity. They consider what is happening today. So, yes, their revenue is 14,000, but their costs, they will look at this cost of 10,000 is at 1st of January, but there was inflation. So those ones, they will look at, okay, what's the general inflation? 5%. And there's specific inflation, 10%. We cannot use general inflation because this consider the consumer price index, the totality of increases in price for all commodities. But the inflation that relates to this item in question is specific, and that's 10%. So they will increase their cost by 10%. When you increase your cost by 10%, 10% of 10,000 is 1,000. So what they will recognize as costs is 11,000. So they will recognize 14,000 minus 11,000 as profits. They will only recognize 3,000. So they are careful. So even if they want to share money, they will restrict it to that 3,000. They will not go and share capital. Because by the time you share and you now go to market, you want to go and restock, you find out that prices have gone up and you will not be able to restock. So the physical concept of capital guys, those ones would consider inflation. Those ones will consider the current market prices. Those ones we consider our productive capacity. Can we restock or not? So this is how ICANN will have asked it in the exam if they were going to ask it. And majorly, that is what all these notes is talking about in chapter 8 on the concept of capital and capital maintenance. And really, that is the end of conceptual framework for financial reporting. You will see, I put some past questions in your notes. I've not even, they ask it every diet is there. Every diet is there. So I advise you to go and look through this note I sent you. There are some I put the solution there. There are some I did not put the solution. But look through these questions. You see the type of question they ask. In 2020, they were asking us the 5 types of economic decisions which are likely to be used. 5 types of economic decision of which financial arrangements are likely to be used. Asking you about 2 advantages of the conceptual framework for 10 marks. 10! In 2018, they were asking you that we should explain the following qualitative characteristics: relevance, comparability, understandability, faithful representation. 6 marks. In 2019, they say we should explain substance over form and going concern. 6 marks. In 2022, they say we should discuss the qualitative characteristics of a financial report. 10 marks. They say we should state, the conceptual framework state that there are 2 concepts of capital. Explain the term financial capital maintenance and fiscal. This one is just what we just explained now. So please, these things are very important, which I think you need to look at and ensure you understand. Okay, so we're going to stop here for today. So in our next class, we're going to start with another topic, and that would be IS1. Now, once we have laid down the background to financial reporting, now we are now going to enter reporting itself. I will start teaching you IS1 that looks at presentation of financial statements in our next class on Saturday. But before I end the class for today, is there anybody that have any question to ask? Anywhere you don't understand and you want me to explain, please, you can unmute yourself and talk if you have any question. If you don't want to talk, you can just type the question, then I'll respond to it.